Good afternoon, everyone. Thank you for joining us today. We're going to get started in just a couple of minutes. Wanted to let you know you have the option of how to listen to today's program through the phone line or through your computer. You can click on the audio tab and choose your method of listening to the presentation. Please also take a look in the handouts tab on the command strip, and you'll find a copy of today's slides if you'd like to go ahead and get those and download. We will be offering CPE credit for today's course. There will be 4 polling questions. Please be prepared to participate in those questions as we go through the program. And finally, there is a questions pod, and you can input questions there for the instructors. We will get started in just a couple of minutes. All right, it is 1 o'clock Eastern. Thank you for joining us today. A couple of housekeeping notes. I'm Sarah McGregor, a director here in the federal tax practice at Cherry Bekaert, and I'm delighted to have my colleagues from our state and local tax practice team to present today to be talking about state taxes and what happens when our workforce goes remote and starts working from home and the impact that's having for us. A couple of quick announcements. We will be offering CPE for today's presentation. There will be 4 polling questions as we move through the program. Please be sure to respond to those as we get through. There'll be plenty of time and reminders to do so. And also in the handouts tab, which is on the command strip on the right-hand side of your screen, there's a copy of today's slides if you'd like to go ahead and download those. Please also put any questions you have in the questions pod. Our instructors will try to answer as many of those as we can during the presentation. And if not, we'll have the opportunity to follow up with you afterwards via email. So thank you for that. We're going to move right on into our program. Just a quick announcement, as always, that these are high-level presentations of information, and your particular circumstances may be different than or may cause a different result. So just be aware of that as you move forward with the information that our speakers are going to give us today. And mentioning that, I'll go ahead and let Kathy Stanton introduce herself and her co-presenter, Ann Yancey.
Thanks, Sarah. Good afternoon, everyone. Glad to be here. My name is Kathy Stanton, and I am the state and local tax practice leader for the firm. And we'll be talking about some state tax implications of the recent changes we've had in this past crazy year, requiring us to work remotely. I don't know about your company, but our firm is still probably 98% working remotely. And we're trying not to make anybody come into an office if they're not comfortable. And I'm sure many others are doing the same. And so again, my name's Kathy Stanton, and I have with me Ann Yancey. She's a director in our practice, and she leads not only the payroll tax area for our practice, but also all credits and incentives at a state and local level. So Ann and I will be giving you some hopefully good and relevant information today. So go ahead, Sarah, to the next slide. And here's the agenda. So I'll go over the agenda and then hand it off to Ann. But we're going to look at, first of all, the payroll implications of COVID. We're going to talk about first the general rules, because there is a lot of confusion on how payroll tax rules work just in general. So we will go over those general base ground rules. Then we'll talk about the complications of a pandemic and the impact of the pandemic on payroll and the resulting tax. Then we're going to talk about states that are providing relief and what type of relief there is. And then we're going to go over some examples of that. And then after that, we're going to look at some other tax areas, and probably more specifically the income tax area, and look at the question of what is that nexus, what are the nexus considerations for other taxes. And if you're not historically like a tax person, nexus just simply means you have enough connection with a jurisdiction for that jurisdiction to impose its tax on you. So nexus is something that is, we kind of referred to it prior to the pandemic as a disease. It's something once you get, it's hard to get rid of, and it's awful. And so many people, many taxpayers feel that way about nexus. But once you establish that nexus, then the state has you. They're looking to impose their tax until you can break nexus. So we're going to talk about that. And I just want to mention here that you may have nexus for one type of tax, but not necessarily have nexus for a different type of tax. So you may have nexus or requirement for payroll taxes, but that may not necessarily mean you have an income tax filing requirement in all cases. So unfortunately, there are levels of complexity to nexus and the various state taxes that are imposed as well. And then we'll talk about how nexus increases your exposure to tax, and how do you get a feel for what that exposure is. At the end of the day, businesses are going to make a business decision, right? If your tax liability is $10 in a state and it costs you $750 to pay Cherry Becker to prepare that tax return, you might make the decision, if I get audited, I'll pay the $10, right? So we always have a business decision involved, a component of that involved, and we're well aware of that and understand that from our client's perspective. So with that brief introduction and review of the agenda, we'll hand it off to Ann to discuss the general rules of payroll tax.
Okay, thank you, Kathy. Next slide. Okay, so as was mentioned by both Sarah and Kathy, the coronavirus has drastically changed how and where employees are now working. And many of you may, find that you have employees that are temporarily working from their home or from other remote locations. And these temporary work arrangements, and sometimes long-term remote work arrangements, raise a lot of questions about how state and local employment tax laws will apply to those employees who live and work in a different jurisdiction. But before we talk about the telework situation, let's start with these basic rules. So the very first rule of employment tax is that the employer's obligation is to withhold and report in the state where services are performed. Sounds easy, but we find a lot of companies still report to the resident state. But again, the correct reporting requirement is to report to the work state. Companies generally base that withholding on information that's provided by the employee. So leaving it to self-report by the employee where they work is acceptable, again, as long as that information is reasonable and there's no intentional fraud by the employee. A lot of companies have to, in their timekeeping system, mark the state where an employee is working. So that's important for capturing that type of data. Local withholding, however, the rules vary by locality, and some localities actually require withholding in the work state and some require the resident state. Next slide. So after you have that general rule down, the next thing to consider is that there are some states that have reciprocity agreements. And reciprocity agreements are agreements amongst certain states whereby the state has agreed to exempt an individual's earned income if they live in another state. So just in looking at the chart, the states on the left-hand side are the work states. So if I work in Iowa and I live in Illinois, reciprocity will allow me to have my employer withhold only in Illinois, my resident state, instead of following the rule of withholding in the work state of Iowa. Now, reciprocity is not an automatic concept. Employers must complete exemption certificates in order for reciprocity to apply. And employers are obligated to really keep these documents in their files. They're not required to report these documents to the states. But if a company were audited by a work state, they would be looking for these reciprocity exemption documents that are signed by the employee in order to honor this concept. Next slide. The next consideration for which state to withhold in is that some states have what's called de minimis or exception rules. There are approximately 16 states here in green which have some type of threshold associated with when an employer is required to withhold for the non-residents that work in their state. And generally, there are 3 different scenarios which you will find. In most states, any wages that are earned by that non-resident while performing services are subject to withholding. So that's the majority of the states. Some states, though, will look at the number of days that an individual spends in that state, such as Arizona says that once an individual works more than 60 days, you're required to withhold. New York says 14 days. The other way that we see that companies fall into withholding requirements is some states say there's a dollar threshold. So South Carolina says that if an individual earns more than $1,000 in our state, you're required to withhold. And then lastly, you have states that have some type of hybrid concept like Georgia that says if an individual works in our state more than 23 days in a quarter, or they earn 5% of their total income in Georgia, or their income is greater than $5,000, you're required to withhold. Next slide. So how do these concepts apply? These are very simplified examples here that we're going to discuss. But in the first scenario, an individual works in Virginia but lives in DC. These 2 states are reciprocity states. So in this case, the resident state of DC would govern for withholding purposes. The next example, let's look at someone working in North Carolina and living in South Carolina. There's no reciprocity here, so the work state will govern as the required withholding state. And then the last example, let's say you have a sales rep that covers the whole Southeast territory and they work in North Carolina, South Carolina, and Georgia. None of those states are reciprocity states. Georgia does have a de minimis threshold, but even with that de minimis threshold, assuming that person hits that requirement, this individual would require withholding in all 3 states. So that's important to remember, is that for withholding purposes, an individual may have multiple withholding states and still only have one unemployment tax state. So just keep that in mind as we're talking through this. We'll go to the question.
All right. So we'll get, let me get our first poll question up and let you go ahead and respond to this. Whether does your business have employees who reside in one state but work in another? So, and looking at the list there, the states with reciprocity seem to be those that have multiple borders, or maybe have a large city near a border where you might have lots of workers living in one state and working in another.
That's absolutely correct. It's most reciprocity agreements are with cross-border states, and again, the most common one that you find are individuals that work in that DC metro area, where you have individuals that work in DC, Virginia, Maryland. Again, so you could live and work in any of those areas and still have your employer only withhold in your resident state.
And even a state like Kentucky may not have reciprocity with every state around it, or the majority of states, but may not be hitting all those along its border.
That's right.
So definitely people living and working in multiple locations is pretty common as it is. All right, I'll give you just another 30 seconds or 10 or 15 seconds to finish answering that poll question, and I'll share the results with you. All right, I'm going to close the poll here and share results. And you can see that a good almost 70% have said, yes, we've got employees that live in one location, work in another location. So this is a very common issue, whether it's just happened or it's been happening on a regular basis. So thank you for that input. Right.
Okay. All right, so let's, Ann brought up a great point, unemployment tax. So we have, in the payroll tax area, we have withholding tax, unemployment tax, you have workers' comp. Unemployment tax generally will not follow necessarily the work state. Unemployment, there's a cascade of rules. There's like a 4-part rule that, if you look at if the employee's working in the state where they have an office and all their work's performed in that state, that's the state that controls for unemployment. But if you have an employee that's traveling around, but they still do some work in a state where they're controlled from, it's that office or that control state that's going to apply for unemployment tax. And so that becomes a little complicated. And that, is your employee actually going to work in the state where they're headquartered during this pandemic at all? Do we need to change the unemployment state or not? But unemployment is a different set of rules, but it is uniform across all the states. So here in the withholding area, we have a lot of unique rules among the states. There's not necessarily any uniformity, but in the unemployment area, there is more uniformity there. And in unemployment insurance, we always refer to the insurance carriers on that and those rules and whether those are impacted or not. But also I wanted to mention that if you think historically and just working, with all the clients I have in the past 3 decades, companies have lots of traveling employees, right? Whether they be sales reps or service people or for whatever reason, you have companies that are traveling a lot. And there has historically been a lot of non-compliance in the area of income tax withholding. As you can imagine, if you don't have a payroll system that tracks where your employees are every day for proper withholding for their W-2, then you're not going to know, where they one day in California 2 days, and do I have to withhold? And it does get complicated with the de minimis as well. We do have some clients that'll say, okay, if they're somewhere for a month, we'll start, just from a practical purpose or perspective. But really, that income tax withholding is due. And so we have had a couple of states that tend to be more aggressive on that in that area. North Carolina is very aggressive in trying to get companies and assess them for employees that are coming into the state. New York has its own for the convenience of employer rule, which is just a different, unique set of circumstances. They're very aggressive in the employment tax area. So we've had some proposed legislation at the federal level, and this is not the first. This act was reintroduced on June 16th, and it was supported by the AICPA, and I'm very involved with the AICPA and the State and Local Tax Technical Resource Panel, and they support this proposed legislation. But this legislation in various forms has been proposed almost every year, and whether we call it the Mobile Workforce Bill or Mobile Worker Relief Act, and basically it's providing some protection for companies. If your employee hasn't been in a state for 30 days, you can't impose the income tax withholding. We have yet to get this passed, and one of the main reasons we can't get this passed is because of New York. And New York is extremely aggressive. The convenience of the employer test says that, if you're controlled out of New York and there's no reason for that company to have another office somewhere else and you're just teleworking somewhere else, it's still New York income for withholding purposes. And so New York does not want this 30-day threshold in place. But we were hoping that this bill would gain more traction with a safe harbor for teleworking due to COVID. But so far, it's just in committee. It hasn't been there too long. And again, look at the 90-day safe harbor for teleworking due to COVID. 90 days, we're past that already, right? If people shut down, and like me, I'm sitting in Maryland, we're still, not back in our office. So I'm hopeful that one of these bills will get through, and hopefully they will. But it's important to note that there is no protection specifically from a federal level at this point. So, Ann, I'll turn it back over to you.
Sure, thank you. Next slide. Okay, so again, let's now consider the telework complications. I mean, we already have a lot of difficult rules to maneuver through just to consider basic withholding tax requirements. Now we throw on telework and it complicates it even more. So these are some of the just situations that I could think of, as that might apply now that we're working remotely from home due to COVID-19. So you have a situation where you're working and living in the same state. That's the easy one. That's there's no issue there. Your withholding is to that same state. No issues related also as a result of teleworking. Let's say you are temporarily working at home from a state that does not have reciprocity with your normal work state. The other scenario is working from home in a state that does have reciprocity with your normal work state. And then what if you are temporarily working from another location in a different state, maybe your parents' home or vacation home that's different from the normal work state? Or what if you're at the beach in Florida and you're working from a state with no income tax, but you normally work in a state that has an income tax? So these are just some of the scenarios that we're seeing clients run into at this point, and we'll kind of talk through some of these situations. Next slide. Some states and local governments have responded with some guidance that addresses this temporary telework situations that we've mentioned here. 22 states have issued some type of guidance, and there's been several cities as well. 6 of those states, and you'll see those 6 states there in that one city of Charleston, West Virginia, they basically say there is no change to the normal rules of teleworking. And what that means is that if you have an employee that's now teleworking in one of these locations where they normally worked in another state, you need to have switched your withholding requirement to these states. So you would be subject to withholding if someone was teleworking now in one of these states. Next slide. There are 16 other states that have responded with guidance as well, and these states and all the cities in Michigan and Philadelphia have all said that if you have an employee that's now working from home only because of COVID-19 and it's a temporary work situation, then we're not going to require you to change the withholding of that individual. Now, Kathy mentioned New York. New York has complicated convenience of the employer rules, but there is some proposed legislation out there in New York where New York is trying to pull this income into their states if someone is teleworking as well. So just one that we're monitoring and trying to stay attuned to what's going on, but it has not passed yet. Next slide. Okay, so again, we've mentioned this scenario. An individual lives and works in the same state. There's no issues, no change to the withholding. It's going to all be to the work state. Okay, in the scenario where someone's temporarily working from home in one state and that state does not have reciprocity with their normal work state, so there's really two scenarios here. You can continue to withhold in that work state. That may or may not be accurate due to the telework rules for, you know, for the remote work state. Or you could turn off that work state and withhold in now the resident state. And that might cause you other types of complications, maybe additional nexus on the corporate tax side. You may now have to register and report for payroll where in the state where you were not already having employees. So different scenarios there, but again, requiring us to take a look at both the rules for general employment tax withholding and also the rules for the telework state.
Hey, Ann, just to ask a question on that. So the choice really, when you're making a choice, if you have the COVID telework rules that protect you, you're saying that you have some choice to do it either way, right? But then if you don't have any protection, you're going to have to follow that normal work state rule.
Yes, absolutely. Absolutely. So for those 6 states that I mentioned before in that city that will require you to withhold in that remote work state, even if it's due to COVID that you're working in that state, you know, that's the rule and that's what will govern in that situation. Now, practicality, you know, says that some companies need to look at that scenario and determine how long someone's going to be working remotely from home. Again, we've already been working, as you said, for 3 months at home. So whether they put that policy in place going forward or go back and retroactively correct that reporting situation is a business decision.
All right. The next scenario we're using as our next polling question. So I'll already go ahead and raise this. So you've got an employee working at home from a state with a reciprocity agreement with the normal work state. So the employer should A, withhold tax in the work state, withhold tax in the resident home state, withhold tax equally in both states, or not sure. So give us your thoughts on whether this is an employee that is working in a state that does have a reciprocity agreement. They're working from home in a state that has a reciprocity agreement with the normal work state. To give us your thoughts on what the employer should be doing when it comes to withholding here. And I'll give you just another second or two to do this. And this is not an uncommon situation that we're hearing about. Just like the last one, we're hearing about folks that have employees in states without agreements, and now some employees that are in states that do have agreements. And they may have an agreement with a bunch of states, but may not have one with the work state, depending on where somebody might be self-quarantining. All right, we've got just about everybody has responded here, so I'll give you another couple of seconds to make a choice, and I will share the results with you. And then we will ask Ann to give us what the answer should be. All right, let me close that poll and share it with you. All right, so about half and half said the withholding should stay in the work state, and half said the withholding should stay in the home state. So Ann, tell us what the answer should be.
You might be on mute, Ann.
Okay, thank you. So this question, these two states have a reciprocity agreement. So the answer would be withholding should occur in the home state. Okay, and that's the exact example here in number 3. In this scenario, again, where there's a reciprocity agreement, and again, reciprocity assumes that the employee has filled out the state exemption certificate. So assuming that's in place, your withholding occurs to that resident state of the employee. And really in this situation, telework doesn't come into play because you were already withholding in the resident state, assuming a reciprocity applied between the states. And so again, it should not change anything just because of telework if you had someone living and working in different states. Okay, next slide. The next scenario, again, there's an employee that's working from a different location than they normally work. And again, consider that being a totally different state that they normally live in or that they normally work in. There you really have to go through the series of considerations, considering reciprocity between those states, considering telework, where you're currently withholding, and determine if that's accurate and if there is a change required due to the telework rules as well. Next slide. And the last state, again, a common example, some people are working from a state now that has no income tax. We've seen clients that have contacted us and their employees insist upon no income tax withholding because I'm now in Texas. While we're under this pandemic, they're working from Texas and they don't want any tax taken out of their paycheck. So again, in this situation, you have to look at the rules for that telework state in comparison. Again, there's no income tax in Texas, but you have to look at that normal, the state where normal withholding is occurring, and that will, in most cases, govern and still require withholding. Next slide. So the things that need to be considered, some that we've mentioned already. Companies really need to consider the impact of their operations on their telework rule, on the telework rules. Again, which states have additional considerations that need to be taken into account? Are you going to follow those rules? Are you going to implement procedures to track where employees are working? Are you going to leave it up on the employee to self-report? If that's the case, do you have any exposure? What's your tolerance for risk in this area? Even things like considering your payroll systems, do you even have the capabilities for employees to report in remote locations or report multiple states? Some systems that we've heard clients have, you cannot even report in multiple states. So how do you track that in those situations? And then considering long-term, again, at this point, we're still under emergency orders in a lot of states, and it's undetermined as to when employers will go back to work and people will stop teleworking. So if this becomes a longer-term situation, then how are the rules now going to be administered? Are we going to just turn off the button and switch to the new state altogether? And then the impacts on the employees. Employees need to understand that they are going to have withholding possibly in a different state. And for companies who were not correctly withholding in the first place, maybe they were withholding to the resident state. If you determine that you want to clean this process policy up and put the correct rules in place so that you're withholding in the work state, the employees might need to be aware of the fact that they now may have multiple W-2s. So again, a lot of considerations that need to be considered for this type of a situation, but we are happy to help any clients kind of think through their situation, provide any guidance, and also help you with these state rules.
All right, that brings us to our next polling question. Let me get that up for you. For those of you that are seeking CPE credit, give us your thoughts about, Ann mentioned 22 states that have issued guidance, whether it was, hey, the rules are as they are, or hey, there is some relief for COVID-19 related temporary work arrangements. Do you have employees that reside or work in states that have not issued guidance? Those other states, those other 28 states that have not issued guidance yet. Do you have employees that are in those states that it's difficult to tell right now what the rules are? I guess we have to assume that they are under the regular standards. And since there's been no issued relief yet for those. So Ann and Kathy as well, it seems like this ability to work remotely for many employees who may not have been working remotely in the past could be a larger trend going forward. And these situations which seem temporary now, but may not be in the long run.
Yes, I would agree with you, Sarah, for sure. I think, a lot of businesses are seeing how they might be able to save some costs on office leasing, and because everyone's been forced to work remotely, they've had to make it work. They haven't had a choice. So it's going to be interesting to see what happens long term.
All right, great. Let me close this poll now then and share the results. And it looks again like a good number of you have said, yes, you've got employees in states that have not issued any guidance at this point in time, which is never helpful when you're trying to be on manage your regulatory responsibilities.
Okay, great. And thanks, Sarah. And one other thing I wanted to mention about the telework employees, we had done a large project for one of our clients that they were continuing to hire new employees through the pandemic, but they were expecting these employees to actually work in the state where they have one location and all the employees generally work there. But they were making new hires all across the country with the idea that they would come to the office, to that specific state. The state was actually Virginia. They would come to Virginia as soon as the stay-at-home orders or work-at-home orders were lifted. And so then they had these new employees in different states. And what's interesting is if you look at the COVID guidance for telework employees, most of them are written in such that they start out saying this was an employee working in a state, right? They don't address new employees. And so a literal reading of that guidance would indicate that new employees may not qualify for that COVID relief. So you have to be careful of that too. Some of the relief that's been provided, it's not necessarily in statutory form. Sometimes it's just a questions and answer or just guidance on the website. So you have to be careful in interpreting that and relying on it, both from, does it cover all employees, but also they have different periods of time that those relief provisions are in place. And so each state, it might not be the exact same time frame. So if an order is lifted or runs out or expires, then on that next day, do you have a liability? So you do have those issues to be concerned with too. So go ahead to next slide. So now we're going to talk about other non-payroll tax. So let's talk about income tax for a little bit here. The income tax area, we have not gotten quite as much guidance, and I am not surprised at all because the states are really trying to be pretty aggressive in reaching out-of-state companies for income tax. It's a way to export their tax liability and not increase tax rates on their own residents. So only 15 jurisdictions have issued some form of COVID guidance pertaining to income tax. And again, like I just mentioned, and also City of Philadelphia, so 15 jurisdictions, including Philly, you have to watch the time limitations like I just mentioned, and here's some examples. If you're under a work from home order that's issued by a government, if it's declared public state of emergency, or simply during the pandemic. So does that mean you have an exemption for 2 years until the vaccine goes, out to everybody? But in the intent, though, underlying all of this COVID relief is that the telework or the employee's presence in the state is temporary. So the intention behind these relief provisions is that it's a temporary situation and it is going to turn around and they're going to go back to those original states that they were working in. Next slide. Okay, so within the relief, again, unfortunately, if you're familiar with state and local tax, we do not have enough uniformity. Each state is its separate jurisdiction and separate legislators, and they have their own concerns, and so you have different rules in all areas of state tax. But in the COVID relief, you may find one or more of these elements. The presence of employees historically creates nexus, and that's certainly for technology and service-based companies. The presence of an employee has historically created nexus, and not necessarily for sellers of only tangible personal property, which I'll get into a little bit. But what they're saying is that for a certain time frame, that physical presence isn't going to create nexus. Now, this is for income tax, but you have to look at sales tax as well. Does this relief expand, also cover sales tax, which potentially it can. Now, in the sales tax area, physical presence also creates a nexus for having to collect sales tax. But as many of you are hopefully aware, in 2 years ago, the Wayfair case that went through at the U.S. Supreme Court level, even having just a certain sales volume for sales tax is going to trigger a sales tax collection requirement. So if you are making taxable sales into states where you have not been collecting, you need to be looking at that on a regular basis because that world has turned completely upside down. And they are not going to care. The only time that the presence of employee would make a difference is if your sales are smaller below the Wayfair threshold. But for income tax, they're saying it won't create nexus for income tax during that certain time frame. Presence of temporary employees won't alter apportionment factor in that state for that certain temporary time period. If there's a 3-factor apportionment, which is how you allocate or apportion income to the state. The third bullet, I think, is really, really important. Federal Public Law 86-272, not lost due to the temporary presence of employees. This is the federal protection that's available to sellers of only tangible personal property. And so with regard to that, there's a federal law. It's old. It was written in the 50s. It was never meant to be permanent. It was supposed to be temporary. But that federal law says that if the only thing you're doing is soliciting for sales of tangible personal property, can't be any services or anything like that, there is protection from the income tax. So if you are depending on that protection shouldn't be lost in those 15 jurisdictions or a subset of those jurisdictions that have specifically addressed Public Law 86-272. Another point I want to make is that in some of the guidance that's provided in some of the states, they refer only to corporate nexus and apportionment? Well, we have LLCs and partnerships and, S corporations, they are corporate, but it is a pass-through. We have different forms. We have sole proprietors. We have different business forms, and some of the guidance only relates to corporate. So again, not a lot of clarity. So you have to be careful if you're trying to rely on some of the guidance. And we would hope, the majority of the states obviously have not issued any guidance, and we would hope that they would be more lenient in the situation, and it's going to be really a facts and circumstances test. I will say that if you've been watching the news, you're very well aware that the state budget deficits have just increased unbelievably. I mean, we've gone from an economy where states had surpluses, not all, but many were in good shape, to now just being decimated. And with, the unemployment and everything that's going on. So they are going to be looking for income. And I will say that, the states have been very aggressive again on Nexus. So I can see why most of the states have not provided any guidance. Unfortunately, you may see some states taking advantage of this opportunity. So you can go to the next slide. Okay, and so I want to talk a little bit about general income tax nexus, because I think, again, if you don't work in this area and you're not following this area, you may not be aware of what's been happening recently. Unless you're covered under Public Law 86-272, that seller of only tangible personal property, and by the way, electronically delivered software generally is not in most cases. It's truly that old sale of widgets into the state. Unless you're protected under that public law, states have claimed nexus regardless of whether you had an employee in the state. So whether you have an employee teleworking, permanent, states don't care. If you have revenue coming from a state where you have a customer and you're getting revenue from that state is going to try to exert economic nexus. And that economic nexus simply says you're earning a lot of revenue from our state, you have to file an income tax return. So historically, as a CPA, we used to look at the apportionment detail for our clients, and we would review the payroll factor by state, or payroll by state, property by state. We would make sure that we're talking to the clients about filing returns in all those states where you had payroll and property, because that historically has created nexus. And then that's what we're talking about, this telework, right? That payroll in the property or payroll in the state. But for service providers, technology service providers, it doesn't matter if you have an employee or not. In the majority of states, economic nexus is imposed. And so just simply having that revenue from a customer in the state. So then it has to be, then we fall back on constitutional limitations. So how much revenue is enough to trip that switch of creating nexus for income tax? How much? And from a constitutional perspective, under the Commerce Clause, it has to be substantial. Well, what is substantial? In the past, the MTC, the state of California, New York, they've looked at substantial as at least $500,000, right? That's substantial. But now that we have this Wayfair case coming through a couple of years ago in sales tax, their threshold for Wayfair was only $100,000. So the states are feeling very emboldened that if you have enough revenue, if you have 100,000 revenue coming from a state, that you should be paying income tax as well, unless you have that Public Law 86-272 protection. Hawaii was the first state to enact statutorily this past year that $100,000 of revenue or 200 transactions is enough for nexus for income tax. So that's a typical Wayfair threshold for sales tax nexus, but they've crossed over and said, we're going to use that for income tax as well. So I want to make sure people are aware of that, and you have to really look at where's the revenue coming from and making sure that exposure is not being accrued for your company. And in order to do that, and in order to do that properly, then what becomes extremely important is how do we source our revenue, right? We're a CPA firm. I sit in one state. I have clients all over in various states, and I might be working with a client in a different state, but the service that I'm providing for them might benefit them in a third state. The state's economic nexus only matters if a state has market-based sourcing to go along with it. What do I mean by that? There are a handful of states that will still look to where the services are rendered. So I'm going to use Virginia and Maryland as an example, and our firm as an example. We have offices in Virginia, a few offices in Virginia. If we have individual staff sitting in Virginia performing all the services of preparing tax returns for a client in Maryland, when filing that Virginia income tax return, Virginia considers that income for the Maryland customer, Maryland client, because the services were actually performed in Virginia. When we file our Virginia tax return, we have to consider that a Virginia sale because Virginia follows where those services, the cost of performance, where those services are performed. But then when our firm, we also have a Maryland office, 2 Maryland offices, when we go for our Maryland tax return, we have to look at, okay, well, Maryland is a market-based state. They're looking at where is the service, where's the benefit of the service being received or delivered? Well, the client's in Maryland. So when we prepare that Maryland return, we have to take that same sale that we just sourced in Virginia, we have to source it to Maryland as well. So it's double counted. It's counted in Virginia and it's counted in Maryland. So we have different sourcing rules among the different states. And if you have market-based sourcing such as Maryland, and I'll use Wisconsin too. Wisconsin's very aggressive in nexus outreach for economic nexus purposes. They look at, okay, if you have a customer, the benefits being received in Wisconsin, you have to file a return. Well, it has to be substantial. We would say, I would, as a professional, say, well, if it's under 100,000, I'm going to argue that's not substantial. I may argue even if it's more than 100,000. But Wisconsin I've seen them argue down to 10,000, which is, just ridiculous. So it comes down to, okay, well, what is source there, right? Can I source it somewhere else other than Wisconsin? Maybe the person I'm billing the services for is in Wisconsin, but I can make a good argument for the benefit of my service is being received in another state outside of Wisconsin. So I guess I know that gets into a lot of complications on the income tax side, but I guess the takeaway is this. Proper sourcing of your income based on the specific state tax rules is a prerequisite for determining whether you have nexus for income tax purposes in the majority of states. So that third bullet, market-based sourcing, is followed in all but 12 states, and even those states try to use and twist their rules to apply a market-based approach. And then I want to end on those that are depending on federal public law 86272, only selling tangible personal property. The Multi-State Tax Commission, which is a quasi-governmental group of various states, about half the states are members of the MTC. Unfortunately, the big states such as California, Texas, New York are not. So they make their own rules, but the MTC really is trying to bring some uniformity across the states. They are revamping their guidance and how they're viewing this federal law protection. And so even sellers of tangible personal property, if you have internet activity and you are chatting with your customers after the sale, if it's something, a technical assistance after the sale and you're just having internet chat, the states are taking the position that that is an activity that's occurring in the state that goes beyond public law 86272, and that internet activity is deemed to occur in that state where your customer is, thereby jeopardizing that federal law protection. So that new guidance is expected to be finalized in this year. I expect a lot of litigation. The states hate that public law. So again, it's not surprising that the states have not provided COVID relief because they want to assert nexus. regardless of whether you have an employee in the state or not. But now, you know, when you do have an employee in the state and you're registered there for payroll tax, the states do cross checks for income tax. So you do have to be very cognizant of that, do some due diligence ahead of time. We do have clients that are very aggressive in the state tax nexus area, but I will say that a lot of those clients, they want to grow that business and then sell it. And so the skeletons in the closet come rattling out of the closet during due diligence when you're trying to sell the company. Then you have years and years of exposure, and it becomes a bigger problem and more expensive to deal with down the road. So it's always good to just make sure you're keeping a tab, keeping your hand and a pulse on what's going on in the area of nexus. So I'm hoping that this presentation, I know we have one more polling question, but I'm hoping that this was helpful in giving you a flavor for, you know, that payroll tax area, the risks that are created, although the protections that are available, and as well as reciprocity may be available to you. You may not have known that, as well as, you know, the income tax area and how you may have some nexus exposure regardless of whether employees are in the state or not, and then what's happening for sellers of tangible personal property as well. So I'm hoping all this has been helpful. We're so happy to help anyone. We love to talk about this stuff, so we're happy to help with any questions that arise as well. And now we get to our last polling question.
Great, and spoiler, you just maybe answered some of this question, but so for our last question, do you think, given the discussion that Kathy just gave us regarding nexus for income tax purposes and perhaps even sales tax, do you think your employees working from home may be generating some additional exposure for your company and nexus in states that you may not have been reporting income tax for in the past? So if you've got employees working and spending extended amounts of time working in states now that they may not have been in the past, or you've got more employees, maybe you just had 1 or 2 working in those states, but now you've got many more that may be working from home or in a state, generating some exposure for your company, whether that's a performance-based or because of a physical presence there, something that could raise some income tax exposure and also some potential for some sales tax exposure. Additional, so we've got the payroll tax exposures, the income tax exposures, the sales tax exposures, unemployment tax exposures, just a host of taxes that companies and employers are having to deal with as a surprise here in 2020.
And Sarah, I'll just cut in, sorry to steal your thunder on that question, but we did get a question come in and it's very relevant. You know, what if a lot of companies now are moving to online, right? What can we do online, obviously? So what if we're doing online physical therapy subscriptions? Does this create nexus? Is it subject to sales tax? These are recorded videos. So unfortunately, yes, that can create nexus issues because you have revenue coming from other states. Pre-recorded videos in some states can be subject to sales tax depending on the state. So yes, those are the questions, and that yes, you would need to look at what you're doing in each of the states, and we'd be happy, you know, to help with that to get a handle on that.
All right, well, thank you guys for participating in today's polls. And as we wrap up here, it's coming up just a few minutes early before 2 o'clock, but we've got our time in for the day. But we thank you for that. And as you can see here, Kathy Stanton and Ann Yancey are available. If you or your company have questions about nexus, about payroll tax reporting, about reciprocity, or challenges in particular states that you're not familiar with, we'd be delighted to talk with you and encourage you to reach out to us from here. So Kathy, Ann, any final comments before we close?
I think I've put enough out there regarding nexus. So
okay, great. Great. Well, listen, we thank you very much, and you will be hearing from us. For those of you that are answer the polls for CPE credit, you'll receive your certificates from our learning team in probably a couple of weeks. They are, of course, as everyone else, working on a skeleton staff and working from home, but we will provide that information for you. And thank you again for checking in with us today.